Kitco Mining special coverage of the Precious Metals Summit is brought to you by New Core Gold.
Gold is at $3,650 per ounce, but has it risen too quickly, too soon? Hello and welcome to Kitco Mining with me, Paul Harris, at the 2025 Precious Metals Summit here in Beaver Creek, Colorado. Joining me today to discuss this is Ronald-Peter Stoeferle, Managing Partner at Incrementum, the publisher of Playboy for Gold Bugs, the very influential In Gold We Trust report. Ronald-Peter, welcome by Kitco.
Hi, Paul. Did you just say Playboy for Gold Bugs?
Absolutely.
Okay.
Trademark, Paul Harris.
Yeah.
Well,
I'm speechless.
Let's get to it. 3,650. Has it risen too far, too soon? It's gone up incredibly. It's up about, let's say, $1,000 since this time last year. It's gone up $200 per ounce in the last couple of weeks.
Yeah. Well, I mean, the numbers are staggering. Such a really big asset class like gold being up 40% year to date, and also making such massive moves within a very short time frame, because we've basically seen a 4-month consolidation. Now we broke out and made new all-time highs basically every day. I would say from a technical point of view and also from a sentiment point of view, yes, we're overbought. We've gone too far. However, in technical analysis, there's basically the saying that an extreme overbought situation is just a sign of a strong bull market. And I think we're now in a new stage of the bull market. Yeah, we're not in this accumulation phase, which is, according to the Dow theory, the first phase of every bull market. We're now in this so-called public participation phase, where the media picks up on the topic. I can tell you, more journalists from traditional newspapers are calling me, national TV is calling me. They didn't call me 3 or 4 years ago. They couldn't care less about gold. We're seeing that all the big banks, they're raising their forecasts. We're seeing that, everybody is getting pretty excited. And we're seeing that what we call performance gold, meaning mining stocks and silver, is slowly starting to outperform. So this is a new stage of the bull market. It's basically the stealth phase of the bull market. However, to be honest, I think and I hope that we'll see some sort of correction over the next couple of weeks, at least 10 to 15%. I think that would be healthy for the long-term picture.
There's been a lot of drivers behind the gold price this year. There's a lot of conflict in the world. There's war in Ukraine. There's war in Gaza. Last night, Israel attacked or bombed targets in Qatar. Poland shot down Russian drones. In the financial sector, there's been a lot of focus on the U.S. Federal Reserve and will it or won't it cut interest rates. U.S. Donald Trump seems to be carrying out a multi-pronged attack on the US Federal Reserve Chair Jerome Powell, who's refused to cut rates so far this year. And now more recently, his efforts to sack Federal Governor Lisa Cook. It's widely expected that the Federal Reserve will start to cut interest rates. I guess the question now is, how deep will those cuts be?
Well, I think, if you listen to Jay Powell, he said that for the short term, inflationary risks are definitely on the upside. We're seeing that many economic indicators are starting to cool down. So we're seeing some sort of a stagflationary environment. Now, Powell will obviously cut in September. Perhaps it's even 50 basis points. Perhaps the gold price is already kind of smelling that. But I think, this erosion of trust that we're seeing, in politics, but also if there's such an enormous amount of pressure, open pressure on the Federal Reserve. This is something that we usually just see in banana republics. So that's definitely something that the market is very, very concerned of. However, I don't think this is just an additional driver for the gold bull market. I think the big structural drivers are different ones. First of all, enormous amount of emerging market demand. Then we're seeing a central bank gold demand. Yeah, now probably on track for another 1,000 tons of gold, the 4th year in a row. Then we're seeing, obviously, that most of the Western financial investors are still heavily underallocated in gold, and they're basically, and this is what the chart picture is telling us, because the corrections are so shallow, so many people miss the gold train, miss the gold party, and they eagerly want to get in. So they're buying into every smaller correction. And therefore, I think, all the political things, obviously, we can talk about them. But I always said that, you shouldn't buy gold because there's a new war or a new conflict. if you have a look at the numbers, this has a short-term impact on the price of gold, but not on the medium and long term. However, what does war mean? It usually means more debt, lower interest rates, and I think that we all know that the debt situation is not really sustainable in the US, but especially now in the Eurozone. I think France, I think for the very first time, has higher bond yields than Italy. We're seeing that the euro crisis is moving from the periphery basically into the center, and that's definitely a big concern that the price of gold is that gold also supports.
Okay. Now, Goldman Sachs said that the gold could rally to $5,000 per ounce due to the perceived threats to the independence of the US Federal Reserve. If that is true, then there's still a lot of opportunity for investors who think they might have missed the rise in the gold price. But how realistic is it for gold to get up to those kind of levels?
Well, we said, Paul, in 2020, we said we presented our gold price model, and we said our base case scenario is $4,800 by the end of this decade. Which is 2030. We have clearly, overachieved that. Yeah. So actually, based on this baseline scenario, very conservative scenario, we've gone too far. However, we also have an inflationary scenario, and I think that in the second half of this decade, I think inflation will make a comeback, and this is what we're seeing, like in many indicators already. So another inflation wave. And in this inflationary environment, gold could spike up to $8,900 according to our model. Now, 8,900 sounds like quite a lot. On the other hand, that's a 19% CAGR from now until 2030. So, is it impossible? No. I mean, gold made 40% year to date. Last year, what was it? 28%. So, I would say that's definitely possible. And again, I think we're now really in the stealth phase of the bull market. There will be the crazy phase, like in the 1970s, like in 2011, when gold really spikes up, when silver and the mining stocks go crazy. And, the last couple of weeks, there were already kind of let's say a preview to that stage, probably. However, I think within the mining industry, we're seeing that, everybody is excited. But outside, I don't really see generalists coming in. I don't really see that we're getting close to a gold mania. And if you have a look at the numbers, I mean, for example, UBS said family offices do hold like on average 2% gold. And the calls that I had with institutional players recently, that institutional players owning some physical gold, they all said, okay, should we take profits now? So they're not considering buying now, which is a sign that, nobody really believes in this bull market. Nobody thinks that we'll go significantly higher, which is usually a good sign.
Well, we'll talk about sort of stocks in just a moment, but I want to pick up on you mentioned central bank buying continues to be very strong. And indeed, for the first time since 1996, foreign central banks hold more gold than treasuries. Gold's share of international global reserves continues to increase while the US dollar continues to fall. Why is this a big deal?
Well, I think, I last year made... Paul, I'm always coming up with analogies from the world of sports. So this year at my keynote, I had some analogies with cycling from the Tour de France. But last year I said, we're seeing, in the grand scheme of things, we're seeing something like a heel turn, which is like in the world of professional wrestling. When the bad guy is extremely popular, everybody likes him, and they say, well, he has to become the good guy. So The Rock is the best example for that. And we're seeing this heel turn in central banking, where gold, basically for 30, 40 years, nobody really cared about gold. Why? Because, we've been in this great moderation. Inflation wasn't a concern at all. And now gold is making a comeback as a neutral, non-inflatable monetary reserve asset. And, we know that basically Washington is the back office of the global payment system, and if basically the compliance officer in the back office says no, then you've got a problem. And we saw that 2022 with Russia, and it's no coincidence that in 2022 central banks aggressively started buying gold. So 3 years in a row, more than 1,000 tons per year. this year. I think first half 483 tons. So I would say that emerging market central banks, they're now kind of remonetizing, they're diversifying into gold. They still have fairly low allocations to gold. And, Paul, with the pictures that we've seen from the Shanghai Cooperation Organization meeting recently with Putin and Xi Jinping and Modi, they looked very, very close. And obviously there's the world is splitting into two different blocks. And I think gold is something that will definitely play a major role in that new system that we're going into.
That super happy friendship meeting you just mentioned, that seems to be sort of taking the BRICS aspect onto another level.
Absolutely. But I don't think that gold is like the central thing for the BRICS. Yeah. But I think that if you listen to the speeches, if you read the reports coming out from the BRICS meetings, I think they're clearly developing a new payment system. Which is a very, very complex thing. Yeah? It takes decades. I think that gold plays a role in that, and it's no coincidence. I mean, that the largest gold consumers are in emerging markets, the largest gold producers, basically. There's a very high affinity for gold, but I think it's not. Sometimes we think the BRICS is all about gold. Yeah, I think it's one part. It's important. Yeah, but in the long, I think they just want to be taken serious. That's where the growth is. That's where, from a demographics point of view, that's where the future is, and that's where also the technology is. Yeah, if you look what China achieved over the last couple of years, not only in cars and other technology, but also military technology, as we saw just recently. So. I would expect that this central bank demand will continue, and the central bank gold survey said that 43% of all central banks will consider raising their gold allocations, which was an all-time high. Yeah? So this will continue to be an important driver.
Okay, you mentioned a moment ago, Ronnie, that gold is becoming mainstream news. Gold stocks are certainly not mainstream news yet, despite the strong gains that they've made. Gold miners are really starting to show the benefits of higher gold prices, and the shares and stocks are starting to soar. The GDX Gold Miners Index is at decade highs. The NYSE Arca Gold Index is at its highest price since 2011. Even Barrick Mining is starting to show some performance. However, you wrote in late August that investors want safe haven gold, but still distrust the miners. Is that still the case, or are you starting to see that changing?
Well, Paul, if you have a look at the GDX flows, last year negative flows, and I mean last year the miners massively underperformed gold. This year on a net basis still outflows, I think 2.1 billion. However, we saw in August, and everybody was extremely excited about that, we saw record inflows into the GDX, but it was like 480 million. So that's pocket change, yeah. If you compare it to the daily volatility in Nvidia, I mean that could be
rounding error.
That's like nothing. So what I sense from many, let's say, mainstream investors, they recognize that that gold is doing well. If they have a look at the charts of, if they're no experts, they usually start with Barrick, Newmont, Agnico, and so on. Their view is, okay, we missed that train. It's too late. However, if you have a look at the balance sheets, if you have a look at the free cash flow statements, if you have a look at, the tremendous job that most of the mining companies did during the bear market, I think now we're seeing a very, very healthy industry. That doesn't mean that many of them won't screw up in the mania phase of this cycle, but I'm still seeing, and I had like 20 meetings so far here, I'm still seeing really, really very, very interesting valuations, and perhaps the market still doesn't believe that the price of gold can stay at these levels, but if they can really sustain those margins, then I think generalist value investors will realize that there's just a tremendous amount of value. So that makes me pretty confident. On the other hand, as you've said, I mean, that was a major move. And if gold corrects, let's say 10%, the miners can be down like 25, 30% easy.
Okay. You mentioned a moment ago, you spoke about performance gold. Then let's take a step back and, what's your definition of performance gold?
So we differentiate. People often ask us, should we buy physical gold or mining stocks? We say, well, the question misses the point, because we have to ask, what's your motivation? So we differentiate between safe haven gold and performance gold. Safe haven gold, that's physical gold. That it's just a strategic monetary insurance policy. As little counterparty risk as possible. Store it perhaps outside of the banking system, outside of your country, whatever. But this is something really buy and hold, something that you ideally inherit, something where you don't, trade around. But then there's performance gold, and this is really an active part of your portfolio. And from our point of view, that's assets that have leverage to gold, which is mining stocks from the gold and silver space, and then obviously also silver, and to some degree also commodities. So our thesis in this year's In Gold We Trust report was, okay, first half of this golden decade, gold did tremendously well. Gold is in a bull market, but what has underperformed so far is performance gold. And usually in the second half of this decade, of a golden decade, this is where silver, mining stocks and the commodities really start to outperform gold. Yeah, and this is what we're now seeing. If you have a look at relative charts, so for example, the miners versus the gold price, then you also the miners or silver versus the S&P 500, for example, you can see, okay, they're stabilized and now it's breaking out, which is a confirmation for our thesis that it's now time for performance gold.
Now, Incrementum, you also manage a fund with gold mining stocks and gold junior stocks. We're at an investment conference for junior stocks. What kinds of things are you looking for your portfolio?
Well, we're extremely active in the mining space. Yeah, so we developed a model for the mining stocks that basically tells us when to play offense, when to play defense, when to be a little bit more neutral. So the signal is telling us since December 2023 to play offense. Yeah, so we are aggressive. Yeah, we're fully allocated most of the time. We are going up the risk curve, so we can take like small caps. We can do private placements. We can be overweight in the silver space, silver junior space even. So we are now playing offense, but obviously as an asset manager, you also have to be cautious of the downside. And we know the drawdowns in this industry. So our conviction is, and I'm doing that for 20 years now, that mining stocks aren't a buy and hold investment. Yeah, you actively have to manage them. Yeah, it's probably the most complex asset class. Yeah, because it's very much macro driven, top down, but it's also very much bottom up, because we all know what can go wrong in a mining project. Yeah. So at the moment we're still playing offense. However, our signal, it might change to a little bit more neutral over the next couple of days. Yeah. So then we would, take some profits, put in some limits, write some options, for example. That's our game plan.
You mentioned we're not yet in the mania phase, but the past couple of weeks have seen the junior miners and developers start to get some wind in the sails. The GDXJ index has doubled this year, although on a relative basis, it's still relatively flat when you look at the past 10 to 15 years. As the GDXJs, the juniors start to get wind in their sails, is that getting into the mania phase?
Kind of, yeah, but we're, I think, still very early on. So I don't know if this bull market ends in 2030. I think we're like in the second half of this bull market, perhaps in baseball terms, like 6th or 7th inning, something like that. But we haven't seen, this phase where when you go to a cocktail party and you say, I'm buying gold stocks, yeah, everybody asks you about your recommendations, or when, the big banks can come out with like crazy forecasts like they did in 2011. The point in time when, Jim Cramer and Dave Portnoy aggressively recommend silver mining stocks. So I think we'll get there. And this was like a little bit of a Vorgeschmack, kind of a preview for what we could see in this mania phase. But based on my valuation numbers, and I showed a couple of charts where we basically value gold from a monetary point of view, I would say that gold isn't super cheap anymore, but it's not massively overvalued from a monetary point of view. And then if you have a look at silver, for example, with various gold-silver ratios, I think that silver relative to gold is still extremely undervalued. So we're still way above the long-term median. Gold-silver ratio is now at 87, 88. So the long-term median is around 60, and in a big bull market, it usually doesn't stop at the median. It ends in extremes. And then I think on an absolute basis, silver is also extremely cheap, because it hasn't even surpassed the inflation-adjusted all-time highs. Yeah, so I think that silver is definitely at the moment it's an excellent risk reward. I think in this second stage of this golden decade, it will massively outperform gold, and therefore our take is from the big long. Be aggressive in the performance gold space, but probably as we discussed, I think we will have to wait for some sort of a correction over the next couple of days, couple of weeks, and then I think it's a really good time to load up and increase your allocation.
It's interesting your sort of comments there about silver. Silver's recently moved through the $40 per ounce, the psychological price point. With what your comment said, it suggests that it's got a lot of potential to move upwards. I think its historic high in last cycle was around $50 per ounce, so it's getting to within the sort of shouting distance of that. How high could silver go?
I showed one chart yesterday where it got a matrix, with various gold-silver ratios. So, and if you have the gold price at 8,900, which would be our price target in a highly inflationary environment, and if the gold-silver ratio goes to 10, well, that's easy math. Yeah, that would be $890 for an ounce of silver. That's not my official price target, obviously. That's what I said at my keynote. Please don't go out.
A lot of people shaking your hand if that happens, yeah.
No, but I think triple digits, it's definitely possible, yeah. It's a function of the gold price. But then, Paul, we're seeing very steady physical demand for silver. It's going to be the fifth year with a supply deficit. What's missing is investment demand. We haven't really seen that, and we know that the silver market is quite tiny. It's basically 10% of the gold market. Yeah, so you don't need lots of capital to flow into the silver market to really have an effect. And so, if we see really stronger investment demand kicking in, then I think we'll quickly see new all-time highs. And again, within this bull market, triple digits definitely possible.
Silver's a wonderful beta. Okay, it's been fantastic. Ronald-Peter Stoeferle, vielen Dank. Thank you very much for joining us today.
Thank you, Paul. Thank you.
And we have a lot more to come from the 2025 Precious Metals Summit here in Beaver Creek, Colorado. So stay tuned and hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of the Precious Metals Summit is brought to you by New Core Gold.